Ladies and gentlemen, it says we are live. Hope everyone's doing well. Guys, these stocks, I haven't even been able to take a first look at Marqeta's earnings just yet. So we're going to be doing it live together because the call kind of starts at 4:30, a little bit more early than what I'm used to. I haven't even had a chance to look at it. Just looking at the stock prices, however, Marqeta is flying over 21% up. Upstart is down 17%, and Toast is up 11%. I knew for a fact, okay, Upstart, it was looking like there was a little bit too much enthusiasm baked into it because that marketplace is the same issue, right? There were some definite marketplace issues with Upstart. Lending Club had sort of shown that off. Even SoFi had warned about it, but by not selling loans. But literally, Upstart doesn't have that ability, right? They sell loans. That's what they do. So that being said, Marqeta, let's jump in and see what it's all about. I just want to make sure that I have all my numbers up. Bear with me. And then we'll get cracking. Okay, let's do it. Let me share some screen. Okay. Oops. There we are. Okay, so let's go through and look at some of the numbers. Net revenue went up 24%. On a quarter-over-quarter basis, that's up 6.3%. So just in line with all the other quarters that they've had recently, similar growth. But let me find TPV. Yeah, so this, although up 33%, has actually slowed quarter-over-quarter. Where was last quarter? Yeah, 50 billion. Now it's at 53.6 billion. Actually, I guess that's pretty much, similar to last quarter. Yeah, it was up 3.3 billion last time. It's 3.6 billion. Yeah, okay. Not too bad there. Let me see what else is going on. Gross profit, 84.6 million. Gross margin, wow, 37%. 37%. That looks like, where's their previous gross margins? Bear with me here so I can find it. If I'm not mistaken, that's actually quite lower. Like, I'm pretty sure they were in the 40s the whole time. Yeah, 42, 43, 41, 49 at the highest. 37 is a definite drop off. Okay, I wonder if that's actually going to change people's perspectives on the stock going forward. See, the reason why the stock is up so much is because Square, let me see if I can just find it on the thing. They even announce it on their, where is it? Not talk about it in here? No, they don't. All right. Well, Square extended their stay for Marqeta for an additional 4 years. Sorry to the SoFi bulls. It saddens me as well to know that we're not going to be taking Cash App from Marqeta anytime soon. They extended another 4-year contract. The problem, the problem with Marqeta before was that 76% of their overall revenue came from Cash App, Square, and Afterpay alone. One company, right? Block Incorporated brought in 76% of their overall revenue. If they were to pack up and leave, it would have been a massive issue. Now, another big problem with the company is we'll have to see how much that even expanded. Yeah, I think even net losses are expanding as well. See, the problem is for Marqeta is that no, actually, net loss did not expand quarter over quarter. A little bit of a decrease quarter over quarter. We're actually at almost 70 or 69 million, now only being 59 million, let's say. What was their net loss margin here? Net loss margin last quarter was 32%. This is 25%. Definitely not as bad. There's definitely some improvements there. The stock is still up over 15.5%. Upstart down 20%. Toast up 12%. We're going to be covering all three of those in the FinTech Frenzy later on. Really excited to hear the call. By the way, guys, let me just really quickly, I'm going to stop sharing real quick because I want to make sure that we can get the call up, is, being the main thing here. So let me just go on and find this call. Quite exciting, though. I mean, Marqeta, knowing that they actually have the contract, is getting me much more excited about this stock in a positive light than ever before. The biggest issue was actually losing that contract because no square means no company. And why can't I hear anything? Okay, there we go. All right, we're good then. So one of the problems with Marqeta, for sure, is that not only does Cash App, Square, and Afterpay make up such a large percentage of their net revenue, but the actual contract that Marqeta has gotten that company for is about 1/3 the margin that the rest of their overall business has. Cash App has an amazing deal with Marqeta. It's why they won't leave them, and it's not that they don't offer an amazing product as well. Obviously, they do. But the newer contracts and the other companies that they're with, they don't get nearly the same deal that that Cash App, Marqeta, or Cash App, Square, and Afterpay have gotten. Now, that could also be a function of them not taking as many services as other businesses, but 1/3 is a massive, massive, amount. I can see a comment right here. Do I have a position in Marqeta? No, I do not. Not right now. Not right now. Super interested in the embedded finance space and banking as a service, and the I find digital payments are going to be picking up more and more and more. That's why I'm so into fintech in general, and the whole idea that they are not only going to be getting into issuing cards, but then issuing virtual cards, and now sort of the new idea of tokenized payments and these sorts of things, like getting into all functions and also credit cards and these sorts of things. They're a definite force to be reckoned with. Things are not looking too bad. Let me see what some of their comments were here. So let me bring this over here and I'll share my screen again. I don't see any bear with me here. I just want to make sure that if there is a presentation that's actually released, that we do have it. Because I know how much you guys like the visuals. Actually I do. Okay, great. I do. Let me just read some of this stuff that's on the screen right now, and then we'll go on to that. In the second quarter, we grew our business to an ever-increasing levels of scale, exceeding our sales bookings goals again and reducing our cost structure. Our execution has been strong, including including accelerating our go-to-market motion, enhancing our product offering, and extending our partnership with Cash App. I firmly believe Marqeta is well-positioned to capitalize on the fast-growing embedded finance space. Thank you, Simon. Really do appreciate that. Yeah, I mean, that is the massive worry that people had with Marqeta. Not Toast with Marqeta. Okay, wait. Let me just finish what I was going to say, and then I'll answer one of the comments in the chat. The reason why I didn't want to invest in Marqeta before was that I did actually have a feeling that with the strong relationship that Anthony Noto had with Jack Dorsey, that there was a good chance that they could actually acquire the Cash App, contracts. I guess honestly, in my assumption here is that Marqeta is offering them such a good deal, like nearly an unprofitable deal. And that's probably why they can't get anywhere near profitable on their business. Probably includes stock-based compensation and the likes of it as well. That's also leading to unprofitability. But that being said, they're offering them such a good deal, and I bet you that not even Anthony Noto will stoop that low to want to offer them such a great deal. Now, in terms of the comment that Robert said, did you say Toast is with Marqeta? I thought Galileo's service Toast. Yeah, no. Toast is doing their earnings today. I'm going to be covering Toast, Marqeta, and Upstart later in the FinTech Frenzy. Today, it's actually at 8 p.m. Eastern Standard Time. A little bit different, just gives me a little bit of extra time to prep all three different companies, because all three of them are very exciting, and I want to get a little bit more information before we move on. They did actually announce a partnership with Fitbank. Fitbank will be both a Marqeta customer and act as Marqeta's BIN sponsor for customers looking to launch in that region. So a BIN sponsor is technically a actual financial institution that has a bank license that can actually host, a lot of the member deposits, allow them to actually pay through there with having the, what do you call it? The regulatory authorization to allow that payment to go through. So essentially, Fitbank is doing what SoFi Bank would have done for Marqeta alone. Marqeta doesn't have an actual licensed bank, so they have to partner with other banks, giving them I can't clear my throat today. I don't know why. They have to partner with other banks, giving away some of that profitability as well. Yeah, I'm really looking forward to that call. That call's in less than 3 minutes now. Let me go over to the other sheet here. I'm much more interested in investing in Marqeta now that they actually have the contract secured, because then it's sort of just focusing on growing new clients and not having to worry that 76% of their overall revenue is going to disappear. Upstart getting slaughtered. Yeah, I know. Here, down 19%. Yeah. That's crazy. See, I was so interested in Upstart, and like I said, I'd never taken a position on it anyway, but I was getting such great feedback that and the same thing is going to happen to Pagaya, by the way. But I was getting such great feedback from Upstart and Pagaya that the marketplace for selling loans was extremely strong. And then Lending Club came out and said, no, that's not true at all. And I was like, oh, okay, well, then if the marketplace is trash, then Upstart is trash. And that was in like crazy optimism while not looking at competitors. So it was very optimistic until other companies started to come out. See, that was one of the things that I totally disagreed with people more than others, is the marketplace is for everyone. If Lending Club is saying the marketplace is bad, it's bad for Upstart, it's bad for SoFi. It doesn't matter. Yes, you can have some advantages on FICO scores and chance to default and all these things, but overall, that's not going to make a doubling in the fair value of selling loans if you have 30 points higher in FICO scores or something like this. It just doesn't work that way. So if one company's telling you that the marketplace is trash, probably is, right? Probably is. One real estate company is telling you that this region's terrible. I would listen to that for future quarters as well, for other companies. Okay. Total processing volume. Yeah, absolutely growing. Revenue is growing slower than processing volume. Quarterly gross profit and gross profit margin. Yeah, that the gross profit margin is shrinking quite aggressively here. 37% is I think the lowest I've seen them ever. Let me see. I've got a chart here that goes back to Q2 2020, not too long. Let me check here. Yeah, the lowest before this was 38%. And that was also in Q2 of 2021. So it potentially could be cyclical. Q1 and Q4 have by far been the strongest comparatively as I'm looking through to this. But yeah, 38%, 37% is the lowest we've ever seen. Okay, that's interesting. I wonder if as people read along, because obviously the Cash App deal is a major part of that, and then people are going to see that and do with what they want with the stock, but then after they actually start reading the other numbers, if they're going to sell a little bit going forward. And it doesn't, Yeah, I mean, it's still up 16%. I mean, there's no complaining there. That's amazing. That's absolutely phenomenal. Upstart drops 20% after hours. I know. Ridiculous. Okay, let me see. Stock-based compensation is growing. Let me throw this into my charts and see um, what I can find here. So, see, this is usually what I like to do before. Where's depreciation? Wow, why did that have such a? Oh, did that have a large kick up because of their acquisition? I wonder. It's just 2 quarters ago. Oh, you can see it here anyway. Yeah, 2 quarters ago it was 1 million. Now it's at 2.5 million. That's a large increase compared. Yeah, it's probably just acquisitions. Okay. Okay. Not much. Not many graphs. They're pretty much what I want to pay attention to now is during the call. Oh, actually, that's probably just getting started. Yep, it is. Okay, bear with me here. Let me share it. They're just doing the forward-looking statements, yada yada yada.
Anticipated future financial and operating results, and further changes in our developments regarding accounting treatment, among others.
Can you hear
These
that?
forward-looking statements are subject to numerous risks and uncertainties, including the risk that our accounting treatment may be subject to further changes or developments set forth in our filings with the SEC, which are available on our investor relations website, including our annual report on Form 10-K for the period ended December 31st, 2022, and our subsequent periodic filings with the SEC. Actual results may differ materially from any forward-looking statements we make today. These forward-looking statements speak only as of the time of this call, and the company does not assume any obligation or intent to update them, except as required by law. In addition, today's call includes non-GAAP financial measures. These measures should be considered as a supplement to, and not a substitute for, GAAP financial measures. Reconciliations to the most directly comparable GAAP measures can be found in today's earnings press release or earnings release supplemental materials, which are available on our investor relations website. A reconciliation of forward-looking non-GAAP guidance is not available without unreasonable effort due to the challenges and impracticability with estimating some of the items, such as share-based compensation, depreciation and amortization expense, and payroll tax expense, the effect of which could be significant. Hosting today's call are Simon Khalaf, Marqeta's CEO, and Mike Milotich, Marqeta's Chief Financial Officer. With that, I'd like to turn the call over to Simon to begin.
Thank you, Stacey, and thank you everyone for joining our second quarter 2023 earnings call. We had a strong quarter, and we just renewed our partnership with Cash App for 4 years. Our second quarter net revenue, gross profit, and operating expenses were better than we expected, resulting in positive adjusted EBITDA for the quarter. In addition, we've once again exceeded our sales bookings. The Cash App renewal represents the final major step in a year-long effort to reestablish long-term sustainable growth for Marqeta. This effort started by sharpening our go-to-market operation, expanding our product line through the acquisition and fast integration of Power Finance, and reducing our operating expenses. I am proud of the tremendous progress we have made, and I firmly believe that Marqeta is extremely well positioned to capitalize on the fast-growing embedded finance market. Let me go back to our financial performance. Total processing volume, or TPV, increased 33% compared to the same quarter of 2022. This was the second consecutive quarter where our TPV exceeded 50 billion. Our net revenue of 231 million in the quarter represented 24% growth year over year. Gross profit was $85 million in the quarter, an 8% increase versus Q2 2022, while our adjusted operating expenses were $84 million, a 5% decrease versus Q2 2022, resulting in positive adjusted EBITDA for the quarter. As we've done in the last few quarters, we continue to grow our business while being very disciplined about our costs. Now moving on to Cash App. We're excited to continue our partnership for another 4 years. We believe this renewal, as well as our renewal with Afterpay earlier this year, demonstrate the value Block sees in our platform and our partnership. This value is exemplified by the scale, flexibility, innovation, and myriad of services we provide to Cash App and Block. While this will impact our financial results in the short term, it's something we expected and proactively made decisions based on this outcome. It also positions us well for the long term, extending our Cash App partnership through the middle of 2027 so we can focus on maximizing our growth for years to come. By working together and continuing to expand the scope of what our two companies can do together, we can both capitalize on this amazing opportunity ahead of us. In addition to the Cash App renewal, we have steadily improved our execution across the company. We've seen considerable sales momentum in the last 3 quarters after implementing the changes in our go-to-market organization in the fall of 2022. Our bookings for the last 3 quarters combined grew 150% from the same period a year ago. Notably, we saw a 50-50 split between net new customers and expansion deals with existing customers, setting us up for a durable growth into 2024. On a sequential basis, our bookings for the second quarter grew 60% from the prior quarter, driven by embedded finance, which accounted for 2/3 of our bookings. In addition, 1/3 of the deals we signed in the quarter were flip deals, where we replaced an incumbent provider, and that speaks to our superior platform and scale. And similar to the first quarter, our international business continues to be a source of new customers, as over 40% of net new customer bookings came from markets outside the United States. We expect that international momentum will be a key growth driver going forward and represents a key advantage for Marqeta. Our single stack platform allows customers to easily launch in more than 40 countries where Marqeta platform is enabled. The most recent expansion is in Brazil with our new partner, Fintech. This partnership gives us a foothold into the largest fintech market in Latin America and one of the fastest growing fintechs market in the world, and where many of our existing customers also have growth aspirations. We also continue to make headway with disruptors looking to embed financial products into their platform. We recently signed a partnership with a well-known cloud-based HR, IT, and employee management solutions company. This company sought a new provider for their global expense management product to replace an incumbent and a Marqeta competitor who couldn't support them outside the United States. This customer also is looking to move their new US volume to Marqeta, a further vote of confidence in our platform. Our focus on increased execution has not been limited to our go-to-market strategy. It's also evident in our ability to offer new products to our customers in a rapid manner. As planned, we fully integrated our acquisition of Power into the Marqeta platform. In late June, we finished integrating Power's code, and as a result, their APIs are now fully integrated. We are on track to offer general availability of the Marqeta credit platform before the end of 2023, with program management, origination, servicing, back office, and ancillary service for consumer and commercial card programs. This improved execution is crucial as we look to unlock additional embedded finance opportunities. As a matter of fact, Marqeta has been in the embedded finance game for over 10 years, way before it was even a buzzword, giving us both expertise and a nice competitive advantage. Our modern card issuing platform has been a foundational element for on-demand delivery, accelerated wage access, mobile banking, expense management, and buy now, pay later. Our gains regarding improved efficiency mirror our focus on execution. We have reduced our operating expenses by $40 million to $45 million on an annual run rate basis. In short, we're delivering, we're executing, we're winning against the competition, all while being operationally efficient. We're also innovating. We're deploying generative AI tools in our customer service offering to streamline our support and risk operations. We also use generative AI to make our product teams more efficient. As an example, our credit and banking teams use generative AI to help generate code, reducing the time spent on code generation and testing tasks by up to 75%. We're also working on a purpose-built generative AI tools created to reduce the time to launch for our customers using OpenAI's large language learning model. It allows our customers to expedite their integration with Marqeta's API and accelerate their time to market. In summary, I'm happy with all we have accomplished this year. We have renewed our partnership with Cash App, Afterpay, and 50% of our non-block volume. We significantly reduced our operating costs and solved our go-to-market problems. We did all this while winning against the competition, acquiring a company, and integrating its product in record time, in 5 months. These accomplishments, not to mention our strong balance sheet, position us exceptionally well as we look to deliver sustainable, profitable growth in the near future. With that, I'll turn it over to Mike for his prepared remarks.
Thank you, Simon, and good afternoon, everyone. We are excited about the Cash App renewal, as well as the progress we have made over the last year on both go-to-market and efficiency initiatives. Before we discuss the financial aspects of the renewal, let me highlight our strong quarterly results. Second quarter net revenue growth of 24%, gross profit growth of 8%, and a positive adjusted EBITDA margin were all above our expectations, driven by stronger volume growth from several of our top customers, as well as expense savings achieved through efficiency efforts, particularly within technology, as well as our restructuring in May. Q2 TPV was $54 billion, growing 33% year over year, continuing to demonstrate our growth at scale. The financial services vertical continues to be the highest contributor to growth, growing several points faster than the company as a whole. This was fueled by Cash App's continued growth in transacting active cardholders and higher spend per active user, as well as customers with accelerated wage access use cases ramping rapidly. Lending, including buy now, pay later, growth was boosted by increased travel spend, as well as the relatively new offerings that deliver our customers BNPL value proposition through a card that can be used at any merchant. Excluding Klarna, which migrated a portion of one program in Q3 2022, BNPL growth was similar to the overall company growth. Expense management TPV also grew in line with the overall company as a whole, slowing when compared to prior quarters due to tougher comps and maturity of the vertical. Q2 net revenue was $231 million, growing 24% year over year, as growth remains strong across multiple verticals, including financial services and on-demand delivery, as well as our Powered by Marqeta business. Block continues to be a strong contributor to growth, as our net revenue concentration increased to 78% in Q2, up about 2 points from Q1. Our net revenue take rate was consistent with last quarter and 3 bps lower than Q2 of last year. The decline versus last year is mostly driven by a mix shift toward Powered by Marqeta volume, as our Managed by Marqeta take rate increased 2 bps, driven by increases in each of our major verticals except for BNPL. Q2 gross profit was $85 million, growing 8%. This growth is about 5 points faster than we expected, roughly a third of which was driven by stronger volumes, and the remainder driven by an unexpected incentive benefit that was a catch-up from previous periods following a review with one of our network partners. Gross profit growth was low in the quarter for 4 primary reasons. 1, we renewed approximately 50% of our non-block TPV between Q2 of 22 and Q1 of 2023, lowering growth by mid to high single digits. 2, we lost a portion of our TPV from one Klarna program starting in Q3 last year, lowering growth by mid-single digits. 3, incentive timing, as our incentive contracts run from April to March each year, meaning that every Q2 we are starting from 0 and build up our volume towards incentive tiers. Due to changes in Visa incentives, we filled the tiers slower in Q2 than we did last year, lowering growth by low single digits. 4, we lost full Visa incentives for 2 of our customers at the start of 2023, lowering growth by mid-single digits. Finally, the unexpected incentive benefit in Q2 was partially offset by lower ticket sizes, which lowers gross profit because of the per transaction component of network fees versus the per transaction component of interchange. The first 3 of these factors will no longer be impactful by the end of this year, and we believe these were relatively unique situations that impacted us all at once because of how much our business accelerated coming out of the pandemic. The 4th factor will lap in Q1 24 and shouldn't reoccur based on our new contract with Visa. Gross margin was 37%. Q2 is typically our lowest margin quarter of the year because of the incentive timing. While the Block net revenue concentration has steadily increased over the past 4 quarters, the Block gross profit concentration has remained relatively steady. This is due to less favorable volume mix within the Block business and improving margins in our non-Block business. The increasing revenue concentration is weighing on our overall margin since our Block margin is over 40 points lower than the rest of the business. Our Q2 gross profit growth, excluding Block, Klarna, and normalizing for items like the unexpected incentive benefit, is about 2.5 times faster than the business as a whole, driven by customers with higher margins growing faster than others, which is more than offsetting the impact from renewals we are still lapping, as well as the loss of certain Visa incentives at the start of this year. Q2 adjusted operating expenses were $84 million, a decrease of 10% from last quarter and a 5% decrease year over year, despite a 1 point of organic growth driven by the inclusion of Power. Our restructuring in late May reduced our workforce by approximately 20%, resulting in Q2 savings of $6 million. On a run rate basis going forward, we expect quarterly restructuring savings of approximately $11 million after we reinvest in new headcount in priority areas, resulting in a net reduction of over 15% of the pre-restructuring headcount plan. Our expense reduction in Q2 was not just the result of restructuring. We have many efficiency initiatives underway. Our technology expenses, which include cloud and SaaS tool costs, were flat in Q2 versus last year, despite year-over-year transaction growth of over 40%. We are leveraging automation and executing thorough reviews of our usage to improve efficiency while simultaneously improving our uptime, security, and performance. We also continue to be mindful of hiring, as well as costs associated with headcount such as travel, and reducing our usage of contractors and consultants. We recorded a one-time restructuring charge of $8 million related to severance, net of the release of bonus accruals and share-based compensation forfeitures, all of which is excluded from adjusted operating expenses and EBITDA. Q2 adjusted EBITDA was positive $1 million, a margin of 0.4%. This result was better than expected, driven by gross profit growth and cost management successes. Interest income was $11 million, driven by elevated interest rates. The Q2 GAAP net loss was $59 million, including a $10 million one-time non-cash post-combination expense related to the Power acquisition, as well as the one-time restructuring cost of $8 million. During Q2, we announced a stock buyback of $200 million. As of quarter end, we purchased 10.2 million shares for an average price of $4.75 for $48.5 million. We ended the quarter with $1.4 billion of cash and short-term investments. Now let's shift to our Q3 outlook, as well as the Cash App renewal. Let me set aside the Cash App renewal for a minute and talk briefly about the business trajectory. The underlying performance of the business is a little stronger coming out of Q2 than we expected a quarter ago. In addition, some of the drags on gross profit growth in Q2 are dissipating in Q3. We expect high single digits percentage points less drag in Q3 versus Q2 from just two factors: the lapping of the Klarna volume loss and starting to lap some of the heavy renewal activity last year. We will continue to see low single digit percentage point gross profit growth headwinds in Q3 from incentive timing as we ramp through the tiers more slowly than in 2022, but that will correct itself by year end. Moving on to the Cash App renewal. We are excited to extend our partnership another 4 years as both parties recognize the growth and innovation that we enable and the success we enjoy together. As we anticipated, Cash App is receiving improved economics given their growth trajectory since our last renewal in 2021. We believe the best proxy for our price, and therefore the way to measure the economic impact of the renewal, is the impact to our gross profit take rate, which measures how much gross profit we earn for every dollar of Cash App TPV. Looking ahead to Q3 and Q4 of 2023, we expect the gross profit take rate we earn on Cash App volume to be approximately 40% lower as a result of the renewal. We believe this price is very fair for both parties, commensurate with market rates for Cash App scale, while accounting for the additional services we provide and our differentiated platform capabilities. We are excited to move forward for the next 4 years. The renewal has 2 structural changes that are important to note. First, the pricing construct. We previously used a net interchange pricing construct where we aggregate the interchange, network fees, and bank fees together, and then determine the split between Marqeta and Cash App based on volume tiers. In the new pricing construct, starting from July 2023, we will charge Cash App a price for the services we provide based on volume tiers, while the interchange, network, and bank fees are passed directly to Cash App. This new construct more clearly defines the price we charge for the value we provide while reducing volatility caused by several business mix factors. We already use this pricing construct with a few other customers, and in those cases, it does not change how the business is presented in our P&L. The second structural change is consequential to our revenue presentation. As part of the renewal, Cash App is taking responsibility for the primary payment network relationship. While we still provide Cash App with the same level of support on every other aspect of the program, they will manage the primary payment network relationship. Although we do not receive incentives on Cash App volume from that network, this change is significant because the costs associated with Cash App's primary payment network volume will, in substance, no longer be reflected in our P&L. Previously, we were responsible for this relationship, and therefore these costs were presented in both our net revenue and cost of revenue. That will no longer be the case starting in Q3 2023. To be clear, this expected change in revenue presentation has 0 impact on our gross profit, but it will materially reduce our reported net revenue. To put the net revenue impact in perspective, in Q3 and Q4 of 2023, the impact of the accounting change will reduce our net revenue by approximately 6 times the amount of the price reduction tied to the Cash App renewal. Now let's talk specifically about our Q3 outlook. First, let me reiterate that the underlying performance of the business is a little stronger coming out of Q2 than what we thought a quarter ago. Second, for each of the next 4 quarters, we plan to share the impact of the Cash App renewal on our numbers given the significance. Our expectations for Q3 are as follows. Net revenue is expected to contract by between 49% and 51%, with an approximately mid-70s percentage point decline due to the Cash App renewal. Roughly 15% of the renewal impact is a result of the new pricing terms, while the remaining 85% is due to our anticipated shift in accounting treatment. Gross profit is expected to contract between 9% and 11%, with an approximately mid to high 20s percentage point decline due to the Cash App renewal. Our gross margin should be in the low 70s. Given the success of our efficiency efforts year to date, as well as the restructuring completed in Q2, we expect adjusted operating expenses to decline by a high single-digit percentage. Therefore, adjusted EBITDA margin is expected to be negative 12 to 14% on an organic basis, excluding the 1-point negative margin impact of the Power acquisition. This includes an approximately mid-teens percentage point decline due to the Cash App renewal, almost half of which is due to the new accounting treatment because of the lower revenue denominator. Consistent with what we thought a quarter ago, we expect our Q4 performance to be a little better than Q3 as we continue to lap the impact of heavy renewal activity in 2022. Compared to Q3, we expect net revenue growth to be 1 to 2 points better, gross profit to be 3 to 4 points better, and adjusted EBITDA margin to be 4 to 5 points better. We anticipate that the Cash App renewal impact will be similar in both quarters. Therefore, full year 2023 performance is expected to be the following. Net revenue is expected to contract by a low teens percentage with an approximately low 40s percentage point decline due to the Cash App renewal, the large majority of which is due to the anticipated change in accounting treatment for Cash App related revenue. Gross profit growth is expected to be positive low single digits with an approximately low to mid-teens percentage point negative impact due to the Cash App renewal. Adjusted EBITDA margin is expected to be negative low to mid single digits on an organic basis, excluding approximately 1 point negative margin impact of the Power acquisition. This includes an approximately mid to high single digit decline due to the Cash App renewal. This 2023 adjusted EBITDA margin, even with the negative impact of the Cash App renewal and the expected new revenue presentation for half of the year, is consistent with our expectations at the beginning of the year, excluding the Block renewal. This is primarily due to our cost reduction efforts, which have been achieved while accelerating sales and without a slowdown in innovation. Without the Cash App renewal, we believe we would have been EBITDA positive this year, whereas now we expect to exit 2024 at a positive EBITDA run rate. To wrap up, we delivered a strong Q2 across all metrics and have been making significant progress to position the company for long-term success. Our bookings continue to show strong growth and momentum as we capitalize on the expanding embedded finance opportunities, which should help diversify our business with strong, sustainable growth. We made significant progress toward our operating efficiency goals with our restructuring efforts, as well as our overall focus on reductions across all spend categories. And of course, our renewal with Cash App establishes a new baseline and sets us up for sustained long-term profitable growth. Before we go to Q&A, we understand the longer-term trajectory of the business, including the Cash App renewal impacts, are of great interest, but we will not be discussing 2024 performance implication during today's call beyond the fact that we will exit 2024 with positive EBITDA. However, we plan to host an Investor Day in Q4 to discuss the longer term with more details to follow. Now let's turn it over to Q&A.
We will now begin the question and answer session. To ask a question, you may press star, then 1 on your touch-tone phone. If you're using a speakerphone, please pick up your handset before pressing the keys. To withdraw your question, please press star, then 2. The first question comes from Tien-Tsin Huang with JP Morgan. Please go ahead.
Thanks so much, and good afternoon, and thanks for going through all the Cash App renewal stuff. I know we're all going to dig into the numbers as you shared it, but I'm just curious at a high level here as we think about the benchmarking exercise here. And I know it's tough to negotiate and talk about it publicly too much, but can you walk us through the benchmarking exercise of the pricing and the new deal on the take rate and just the general fairness, right, to all stakeholders on the renewal? Just I know a lot of people are listening on, competitors and other clients, et cetera, but just love to understand a little bit more about the benchmarking exercise. Thank you.
Thanks, Tien-Tsin. Really appreciate the question and good to be talking again. Let me put it this way. We strongly believe the deal is extremely fair for both parties. It is actually commensurate with the scale and the volume that Cash App has achieved, and also commensurate to the value, the differentiation, and the premium that Marqeta commands over kind of like what the market price is. So it is a very, very fair deal for both parties, and honestly sets us up for the right amount of growth for the next 4 years. As we baked into the existing renewal, the right tiers that we believe we will be on as Cash App grows. Mike, anything to add?
No.
Perfect. No, appreciate that. So just my quick follow-up, just to verify, the exclusivity on the deal is, and just maybe visibility, as you just said there, Simon, just thinking about visibility from here, not only from Cash App, but as you want to, reorient towards gross profit growth again, can you talk to visibility and what the growth algorithm is, starting with the second half of this year?
Sure. Let me address the first part, and then I'll hand it over to Mike. In terms of exclusivity, there are actually no changes to that part of the contract. It's exactly what it was. But I would say that there's two reasons companies actually diversify. One of them is economical, and the second one is more stability, which is kind of like you distribute your load on multiple providers so that you actually have some form of redundancy. We've addressed both, as in like in the agreement, we've baked the economical incentive for us to capture the vast majority of the volume, right? And we've done a lot of work on the redundancy and the stability of the platform, and something we've demonstrated. So we've almost reduced the reasons for diversification almost to something non-existent. In terms of a gross profit, yes, that's fundamentally how we look at our business. And we believe the gross profit growth is going to come from three areas. One is the bookings that we've been exceeding on are eventually going to translate into revenue and gross profit. Second one is our base will continue to grow, and there's plenty of opportunity with growth with Block, through Cash App, through Square, and through Afterpay. So that's where we expect the gross profit growth to come from.
Yeah, the only thing I would add, Tien-Tsin, is that when you think about what's weighing on our growth right now, it really does stem from the incredible weak growth that we saw sort of in the 2021 timeframe coming out of the pandemic. Many of our customers' business just absolutely boomed. And that meant that a lot of our deals needed to be adjusted because their businesses were just much bigger. And that process started last year. As we've talked about 50% of our non-Block volume we renewed over a 4-quarter period, ending in Q1 of this year. And then this year we've renewed Cash App as well as Afterpay. So we've really now renewed a lot of the business that we had before that just incredibly grew. And so once we get past that, now we're in, good longer-term contracts that we can grow the business with the customers we already have. And you combine that with the sales momentum we have because of just how differentiated our combination of modern, flexible platform that's global in scale for both debit and credit. It's just a very unique value proposition. And so, that's where we think the growth is going to come from. Obviously, the next 4 quarters there's going to be noise in the revenue, and we'll do our best to try to help everyone understand how much of that is just coming from the revenue accounting change. But as long as you focus on gross profit growth, you'll have a sense for how the business is performing.
Hey, thank you so much. Glad to get the overhang out the way.
Our next question comes from Darrin Peller with Wolfe Research. Please go ahead.
Congrats, guys, on these announcements. Great to see. Maybe just, if you don't mind, just a little bit more plain vanilla clarification on the Block renewal in terms of like what it actually does to your gross profit dollars. And just to be clear, from pre to post on a either second half 23 basis or an annualized basis, just maybe if you can bring it down to us a little bit. There was a lot of moving parts in the growth rate impacts you talked about. And then,
yes.
And then just very quickly also on that, I heard Afterpay was renewed earlier, I think, and obviously Cash App here. I don't think I heard about sellers. So just a quick update. Thanks, guys.
Yeah, so let me take the first part, and then I'll hand it over to Simon to talk about Afterpay and Square. So the way to think about it, Darren, is it's a 40% reduction in our price. And by that, by our price, what I mean is the gross profit take rate. So the amount of gross profit we make for every dollar of volume, which really is the best measure in this case. And the accounting change, I guess, let me just take a minute to try to explain it in simple terms. I mean, essentially, what we used to do in our net interchange structure, right, is we took interchange, network fees, and bank fees, and combined that together, and then said, how should we split that between Cash App and Marqeta? And obviously, they got the bulk of it. But when we were determining that split, we knew we were responsible for those network and bank fees, and that had to be incorporated in how much we kept because we have a cost to pay in our cost of revenue. And in the new structure, what's happening is now the primary network fees are not going to be our responsibility. And so what we essentially book in our revenue will no longer have to account for the fact that we're going to have to pay that cost. And so what happens is our revenue is significantly reduced, but so is our cost of revenue. And so it's not impactful to the gross profit ultimately, but it will be very meaningful, as I said, to the revenue growth, and we'll just do our best to help you sort of normalize for this impact over the next 4 quarters.
Okay, but net 40% of what you would have otherwise earned in gross profit terms, less than going forward, I guess less than before, correct?
That's exactly right.
Okay, all right, that's clear. Thank you. And then just on the other side, Simon, if you can.
Yep.
Yes. We did renew the Afterpay partnership before. We just renewed Cash App. And like I think we said multiple times, there's so much activity going on between Block and ourselves. So it's a very fluid situation. And Seller is not due to be renewed till later in 2024. So we'll be working on that as well. But again, between now and then, I expect a lot of great work that will happen between us, Cash App, Afterpay, and Seller. It is a very symbiotic relationship. It's a daily relationship. The growth they have witnessed is fascinating, and we're actually celebrating every moment of that.
Okay. And just to be clear, and I'll turn it back to the queue, but you got the Seller, the Cash App and the Afterpay combined is the vast majority of your gross profit contribution from Block.
That's right.
Correct.
Okay, good. All right, congrats again, guys. Thanks.
Thank you.
Thank you.
Our next question comes from Ramsey Balasal with Barclays. Please go ahead.
Hi, thanks for taking my question this evening. Following up a little bit on Darren's question, can you help us think through on sort of a hypothetical run rate basis what the revenue and gross profit concentrations will be with Block versus non-Block? I assume that might be the silver lining here, that this deal will have Block be a lower concentration of your overall business on a percentage basis, but just wondering your thoughts there.
Yes, you are correct, Ramsey. What we expect based on this is that our revenue concentration is likely to fall sort of in the mid to high 20s percentage points, and gross profit concentration was likely to fall around 10 percentage points based on this deal going forward.
Terrific. And then I wanted to ask a question on bookings conversion. You've had another terrific sales quarter. Remind us again about the bookings conversion timing. You've now had 3 quarters of solid sales. At what point are you really start to feel those, maybe the earlier sales in that 3-quarter period start converting to revenues? Is this still a 2024 kind of an event, or could we start to see something start to show up here before the end of the year?
Thank you for the question. I think we're going to start seeing something before the end of the year. Just to guide you, on average, commercial programs take us between, call it 60 days to 180 days for them to go live, and then they ramp from there. Consumer program take about a year to launch and then start ramping from there. So the bulk is going to be seen, the sustainable growth will be seen in 2024, but we're going to start seeing some of those programs accelerated and trickling in towards the tail end of 2023. And Ramsey, it's a priority for us to accelerate delivery, kind of like all eyes are on the delivery, giving this oversized bookings number. So no pressure, delivery team, but that's what we're working on.
Fantastic. Well, congratulations on the renewal. Appreciate your answers.
Thank you. Thank you, Ramsey.
Our next question comes from Ashwin Shirvaikar with Citibank. Please go ahead.
Thanks. And let me add my congratulations on getting this done. In terms of just kind of thinking about the gross profit margin range going forward, could you maybe add some color to what happens to that? And part of the question is it's I don't know if I heard this right, but you're kind of, as you've been signing these renewals and the newer bookings, you're leaning more towards just looking at things on a gross profit basis. What % of your total volume, if you will, is on that basis today, if that makes sense?
Sure. To answer the first part of your question, Ashwin, I said that in Q3 we expect our margin to be in the low 70s. As we've talked about previously, our block margin, is sort of under 30%. The rest of our business, is over 70%. So there was a more than 40% gap in the margin, and a lot of that was fueled by the high network costs, and we've talked a lot about what made Block lower margin in the past, and so by removing those costs from both therefore our revenue as well as our cost of revenue, then the margin now for the company is gonna be more reflective of the non-Block business in the past, and so that's what you should expect to see.
Understood. And just kind of going back to Simon, your comment with regards to embedded finance being sort of, it seemed to me, an overwhelming portion of the newer bookings. Could you maybe break that down for us in terms of the types of use cases and the types of functionality that you're bringing to the table for that?
Sure, absolutely. The good news here is that the use cases are diverse based on the segment, and also they're diverse from a global perspective. I'd say there's few core use cases that are coming to us. One from the retail and the broader retail and the marketplaces. They're looking at us for three types of solutions. The first one is your traditional co-brand. So you create basically a co-brand card, but it interacts with the marketplace. So as consumers go to the marketplace and shop, the behavior of the card, especially in terms of rewards, is actually changing. So the card is alive. The second thing they're looking for us is point-of-sale lending, whether it's BNPL or something more creative like that, whether they do it themselves or they do it with partners of ours. And last but not least, seller financing. So given that we can cover all these bases because of our credit solution, we become attractive to the retail marketplaces in general. The second, I'd say, a use case that's growing fast for us is accelerated wage access, whether it's shift or gig work, or actually that are in liquid marketplaces or in large retailers that do employ a large contingency workforce. That actually use case, accelerate wage access, getting a pay card that they get their wages immediately without burdening their working capital, is something that I'd say is a very strong demand, and it's global. Third thing is expense management and supplier payments and cardifying those. So using the card networks, Visa and MasterCards and others, in order to streamline and simplify supplier payments, even extending credit to some suppliers given the economical situation. I think that gives you some flavors of the breadth and depth of the solutions that we are seeing. There's a lot more.
And Ashwin, I just realized that I didn't answer the second part of your question in terms of looking at things on more of a gross profit basis. So you're right. I think what we don't look as much at the gross profit margin because for things like in the credit business, for example, you do have a little bit of higher cost to deliver that product, but you can charge for it. So the margin might be a little lower than in debit, but the gross profit take rate, so how much money you're making in gross profit for every dollar volume is better. And so that typically, what we tend to really focus on, that also helps us normalize the differences between our powered by and managed by businesses, right? That have very different revenue structures, but on a gross profit basis, they're much more comparable. So, that's really the lens with which we evaluate the business and, existing customers as well as new customers when we're bidding on business.
Thank you for that. Thanks.
Our next question comes from Craig Maurer with FT Partners. Please go ahead.
Yeah, hi. Thanks for taking the question. Wanted to ask about the new BIN sponsorship in Brazil. Brazil is a pretty crowded market with some strong issuer processors, and wanted to ask what your expectations are for that market and whether or not you're seeing demand from players outside Brazil looking to issue in Brazil, and that might be part of the motivation. Thanks.
Great question. And we agree, Brazil is moving very fast. Correct, to answer you directly, most of the demand we're seeing today, given kind of where our brand resonates, is international customers that are expanding into Brazil. And that's where we're getting, I'd say, the most traction. That does not mean that since we're there, we will not take what I call some domestic companies that are looking to grow. But the vast majority of what we have in the pipe is U.S. companies or European companies setting their eyes on Brazil to expand.
And because it's so seamless, Craig, to do that on our platform, what we often find is with many of our multinational customers, once they use us and expand into a few markets and they see just how seamless and easy it is, then once they've done a couple, then they say, okay, we need to sit down and talk about where else I want to go, because we make it pretty pain-free, and that's pretty unusual in our business, that you could move from market to market and not have to do new integrations and new setups.
Thank you.
Our next question comes from Bob Napoli with William Blair. Please go ahead.
Thank you, Simon, Mike, and good to get that deal behind you. I know you had mentioned, I wasn't clear though, on EBITDA positive exiting 24. Just any thoughts on, I know you've been working on this deal for a long time and profitability post-deal, so just any thoughts on what kind of, when you're EBITDA positive post this deal, and what you think the long-term model looks like from a growth and profitability perspective now that this deal is behind you.
Yeah, thanks for the question, Bob. I think that the way we look at it is, I think, probably consistent we may have talked about in the past, which is, as a platform business, we sort of naturally get the scale benefits, and up until really, I guess the Power acquisition was the last piece. Last year we added our banking and money movement capabilities. We added our risk product suite. Both of those were done sort of in the second half of 2022, and then we acquired Power early this year. And we really feel like that has, put all the key components of the platform are in place. Of course, we will still add capabilities, but the foundations and the anchor tenants, if you will, are in place. And as well, in addition to that, we've built up a good-sized team where we feel like we have a lot of investment capacity to continue to support our growing business and continue to innovate. So what that means is we can start lowering or slowing the pace of our incremental investment, given that we have the platform is ready and we're more just making improvements to it. and we have a lot of capacity to do so. And if you then see the new sales kicking in, and us, lapping some of these, all the renewal activity that we've done, and we've said in the past that a lot of these deals are more than 3 years. So, you're looking at deals that are pushing out, 26, 27, 28. We think the combination of those two factors means, we're going to get back to an exciting growth, and we will very quickly be adding profitability in chunks, right? It's not going to be this slow ascent. We should be able to deliver, pretty strong gross profit growth without high expense growth, at least for a year or two, to make a lot of progress in the profitability we can deliver.
Great. Thank you. I guess just on maybe following up on Power and on the credit business, and maybe a little bit more color on how Power is progressing, the cross-sell capability, and just the outlook that you see for your credit business.
Sure. Progressing well. So we're done integrating the technology. Now our customers can get the APIs and start testing. So in terms of cross-sale, the nice thing here, Bob, is that Marqeta has been in the credit business. It has not been the program manager. So our pipeline did not start right after the acquisition. Our pipeline was actually booted up before. So we have very strong deals in the pipeline, and we're comfortable. We're going to close a few strong partnerships in the next half of the year.
Yeah, the only thing I would also add, Bob, is I feel like we're also getting a little bit of a halo benefit from the acquisition, in the sense that we have customers or prospective customers who may be looking to do debit first, but they know they might want to do credit in the future, and the fact that they could do that seamlessly with us is a big benefit, and vice versa. Customers who may be looking for a credit product, but they say, might we do something in debit down the road? Yes, and the fact that we could seamlessly do that with you is a big benefit. And so I think that's also helping us just more broadly in our sales, not just credit sales.
Thank you.
Our next question comes from Bryan Keane with Deutsche Bank. Please go ahead.
Hi, guys. I'll also echo my congratulations on the deal. Just a clarification. I wanted to try to isolate business loss with Block, either going in-house or any work going to competitors. And then what new scope work is expected from the contract, if any?
Good question. I don't believe there's anything going in-house that we know about. So from a pragmatic perspective, it is continuing and strengthening our partnership. Brian, there's a lot we're doing with Block across the board, and ranges from small changes to programs to some really cool and highly innovative products that will probably see the light of day in the next 6 months to 12 months. Early to talk about, but there's a lot being worked on.
Got it. And then once we get past, we anniversary this contract renewal for just the Block aspect in the second half of 24, how will the contract grow? Will it grow by Cash App transaction growth or accounts, and will it have positive growth with the growth of the business?
Great question. Mike, you want to take it?
Yeah, I would say, so yes, it will continue to grow. We have it set up where, the best way to set up these contracts, we believe, Brian, is to make it a win-win. So the way you try to set up the pricing and the tiering is that as they continue to get bigger, it's still accretive to us, but they maybe get they grow a little faster than we do. So they accrue a little bit more of the upside as they get bigger, as they should, but we still get nice growth as well. And so that's really how we tried to set it up, which, aligns our interests and is a win for both parties.
Got it. Thanks so much.
Our next question comes from Andrew Jeffrey with Truist Securities. Please go ahead.
Hey, this is Julian Brochet on for Andrew. Thanks for taking the question. Switching gears here from all the Cash App questions. What is your primary competition on earned wage access? I know you touched about it on the call here. You said there was strong demand and it's global business. So kind of who's your primary competition there?
The way we've implemented accelerated wage access is actually unique to Marqeta. I don't want to go into an extreme level of detail, but it's done in a way that the companies are not draining their working capital. So there's no solution in the market today that does what we do. Now, that's something specific. Now, in broader terms, there are, I'd say, independent software developers, some of them based on Marqeta, some of them others, that take an independent approach, like their fintechs. They go to a labor marketplace and say, I give you a solution. So that is there. But also it depends on the size of the marketplace. And we have some very deep relationship with some of those ISVs, like Branch. We work very closely with them on accelerated wage access, and they're a great customer of ours. So, I mean, to summarize, I'd say the way we've done it, no one has done it this way, but it doesn't mean that there's other perspectives on how people can implement accelerated wage access. Again, what we're trying to do with the accelerated wage access is to be the entity that gets the employee what they want without without burdening the balance sheet of the technical employer.
Got it. Thank you for the clarification. That's helpful.
Sure.
Maybe time for one last question.
Sure. Our next question comes from Jason Kupferberg with Bank of America and Merrill Lynch. Please go ahead.
Hey, this is Cassie Chan on for Jason. Thanks for taking the question. Just quickly wanted to ask about July trends. Anything you can share there relative to June or the second quarter around TPV or ticket size, maybe managed by versus powered by? Any color there. Thank you.
Yeah, I would say overall, the trends are stable. We're not seeing a meaningful change in the trajectory of the business. So steady as it goes.
Okay, and if I could sneak in a quick follow-up. I know you guys
Sure.
mentioned for the second quarter, you guys had some unexpected incentive benefits. Could you just elaborate a little bit about that? How much did that contribute to gross profit growth in the quarter? And just to clarify, you're not expecting that to continue into the third quarter, correct?
That's correct. So our gross profit growth was about 5 points faster than we expected, and roughly 2/3 of that is driven by these unexpected incentives. And really how it came about is we're obviously in close contact with all the networks and constantly talking about the business that we're doing together. And as part of that, we discovered that we had actually been owed more incentives than we had been paid in the past. And so, as part of that discovery, we were, I guess, paid our appropriate compensation. And so that was really just a one-time catch up for prior periods that we benefited from. So it's not something that will reoccur.
Great. Thanks so much, guys, and congrats on the quarter.
Thank you.
Maybe we do have time for one more.
Yeah.
No? No. No,
there are no more questions in the queue.
Oh, perfect.
Right. So
thank you.
Our Q&A session has been concluded. Thank you for attending today's presentation. You may now disconnect.
She does sound like she's about to cry, doesn't she? Jesus. Sounds like someone's trying to sleep in the background. She's like whispering over the call. I don't know. I don't know if we'll hear about her next week or next quarter. Yeah, that was quite interesting. Not how I expected that to go. There is definitely some good and some bad, and like in the way I'll crunch the numbers for you guys whenever we're talking about this company in the fintech frenzy. Guys, I do a recap after these earnings. Today it'll be at 8 p.m. Eastern Standard Time. 8 p.m. Eastern Standard Time for the FinTech Frenzy. I'll be going over Marqeta. Congratulations to those who are holding this stock. It is up quite a lot. Toast. Congratulations to you guys. You guys are doing absolutely phenomenal. And then also, I apologize and feel sorry for the Upstart holders. However, maybe I don't need to. The stock is up so much since the beginning of the year. So I mean, you guys have some gains to play around with. It just maybe would have been nicer if you sold at the top, right? But who even in the right mind would have even have thought that would have gone all the way up into the $70 ranges? Jesus. So, ladies and gentlemen, I will see you all back here at the FinTech Frenzy live at 8 p.m. Eastern Standard Time. Upstart trash, I don't believe that, but I just believe it's terrible macro, terrible marketplace, and it probably won't return until Q1 of 2024, even if that may be Q2, but we'll talk about it later on. Thank you all so much for spending this time with me, but that's all. Bye for now.